So we've talked about the downsides and we've talked about the challenges of a high interest rate environment. There are upsides as well, because I don't know if you've looked at a savings rate lately for a high yield savings account. It's a lot higher than it used to be. So what are some of the benefits of maximizing cash right now, and how could people do it?
If you look at what a bank's going to offer a checking account that's going to be next to no interest, if any. You have a savings and a high yield savings that's going to give you a little bit more interest rates. Then you've got CDs and money markets. They're all used at different points in the structure. For example, when rates are rising, you want to be in money markets because they're going to be floating higher with rising interest rates. When interest rates are going down, you're going to want to be using CDs to lock it in at lower rates. As it goes down, you'll hold on to those rates longer. When we look at this and helping client, we do a lot of corporate treasury management for clients. So corporations, institutions that have big cash positions that they need managed. We'll look at the CD rates, we'll look at the money market rates, and then we're moving the money between treasuries and CDs and money markets, all based upon what's going on in the interest rate structure. There's a lot to be done nowadays in the cash management world. It used to be they weren't paying anything, and here it didn't really matter.
Well, let's look at the screen. That's what we have up here. These are money market yields, and the data doesn't go back very far, but you can see in May 2021, May 2021, this is not a thing.
Right.
And then right at that part, spring, summer 22 up. And so, hanging out in the 5s, right? And now back down a little bit to 4s, a part of a portfolio, maybe when they weren't before. And as we're talking about, hey, this is a place where you could put some money, but not everything, right? Depending on the person, it's all specific to the person. What are some scenarios where people would have things in CDs and money markets versus, say, a Roth or other account types?
Well, obviously, if you need the money in the near future,
The liquidity.
You're going to have liquidity in money markets. CDs are liquid-ish, depending on the duration and if you need the money. But typically, money you're going to need in the near future, or you're fearful of losing for some reason, belongs in something like a money market or CD. Here's the trick, though, with money markets and CDs, you're making a rate of return, but is it counterbalancing cost of inflation, right? And that's the trick, right? So you don't want to have so much money in conservative investments that you're getting chewed up by inflation, right? Because the value of that dollar is going down. So you don't always want to be just stacked in a money market. Sometimes you want a portion, right? So we typically say 3 to 6 months in savings, depending on your situation, maybe 9 months. We call lazy money market, CDs, things like that. And then everything else should be invested in some type of the market.